All right, why don't we get started? Again, welcome everyone. On behalf of FrontierView, thank you for joining our webinar series. On today's webcast, we will be unveiling and diving into our 2021 events to watch. This is our annual flagship analysis of the key potential disruptors that multinational corporations should be closely monitoring in the coming year. This year, we highlight 6 global events. My name is Richard Leggett, and I'm the CEO of FrontierView, and I'll be moderating this discussion. I'm delighted today to be joined by Ryan Connelly, FrontierView's chief economist. Ryan and I would like this to be a highly interactive discussion, so be sure to click on the Q&A box on the right-hand side of your screen and send your questions to FrontierView webinars, and we'll work to get as many questions included in the discussion as possible. Also, as a reminder, if you're a client, you can access all of Ryan's research and all of our market intelligence research and data on your FrontierView desktop and mobile applications simply by logging on. If you're not a client, for registered attendees of this webinar, we are offering complimentary trial access to FrontierView. To take advantage of this offer, please request a trial in the comment box or simply visit our website at www.frontierview.com and click the request trial button. Before we get started, we realize that some of you may be new to FrontierView, so I'd like to take a minute to provide you with a quick overview of our firm and how we support multinational executives. FrontierView is a premier global market intelligence and advisory firm. Our primary focus is on serving the market intelligence needs of global business professionals at multinational corporations by informing and powering their market monitoring, strategic planning, and international growth priorities. From the very beginning, we built FrontierView to be different in 3 primary ways. First, our product and service model has been purpose-built to serve a global business audience. In every aspect of our work, we strive to separate signal from noise and answer what we call the so what, now what questions that are unique to the international business professional. Second is our model. We call that strategic intelligence as a service. FrontierView is the only market intelligence solution that bundles together information resources, analyst advisory services, and senior executive network events, such as this one, in one simple monthly payment. And finally, we are especially proud of our world-class technology, which powers the FrontierView desktop and mobile application and has been built with the sole purpose of informing our clients' workflows and decision processes. We are incredibly proud of our client base, which today includes a community of over 4,000 global business professionals and is growing rapidly, some of which you see here. Again, if you are not a client and interested in receiving trial access to our FrontierView program, please visit our website and click the request trial button. Now, having briefly introduced our company, I'd like to take a moment to introduce our presenter, Ryan Connelly. Ryan is FrontierView's chief economist, as I mentioned earlier, and he leads our global economics team and is responsible for coordinating the views and forecasts of our global research analysts. He also covers the North America market for FrontierView clients. Ryan, thanks for joining me today.
Hey, Rich, thank you very much for hosting this.
It's a super timely discussion and actually one of my favorite ones each year. Many of our clients are finalizing their 2021 strategic plans and building their execution models for the coming year. And as we know, planning for this year is as complex as ever due to the massive amount of pandemic-related uncertainty on top of the usual set of macro forces. And we have a lot of ground to cover over the next hour or so. And if possible, I think the way I'd like to run this is to break our discussion today into 3 main topics. So first, I think it's helpful to just give our listeners a quick primer on what our events to watch methodology is, and also do a review of our 2020 list as just a scorecard, if you will, or status check. Secondly, I'd like to set the stage for the baseline expectations that you've already factored into this events to watch for 2021, and that essentially form the backdrop for the 6 events. And then finally, I want to spend the bulk of the time discussing as many of the events as we can, their likelihood, the implications for multinationals, and what strategies for success they could deploy. So a lot to cover. Does that sound good?
Yeah, that sounds perfect to me.
All right, why don't we get started? So Ryan, each year we produce several hundred research studies and rapid response notes for our clients. How does events to watch fit into our research framework, and how should clients best use this analysis and research?
Yeah, so I think that this really goes hand in hand with our normal forecasting process. And so in a sense, we practice what we preach here at FrontierView. And so when we talk to our multinational clients about understanding your global business outlook for the next year, macro is one of the key components into that equation. And so we take the macro side very seriously. It's sort of what we specialize in. What's happening with consumer demand trends, overall consumer growth, pricing power due to interest rate movements, exchange rate movements, CPI. It's very much our view that you can't really have a well-established base case without having pressure tested that view by considering upside and downside risks that are fundamental to that view, right? And so in a lot of cases, we have upsides and downside risks, which we pressure test and we say, okay, we think that this economy is going to be relatively resilient. We're still concerned about, let's say, a currency crash or a housing crash, but we put that likelihood at less than 50%, right? Maybe it's 10%, maybe it's 20%. It's big enough that it could be very disruptive to the business environment and dramatically change your plans. In a lot of cases, that risk is high enough, specifically to that business, that risk needs to be met with some sort of a strategy in advance, right? To be prepared in advance, be that upfront hedging, be that contingency plans already in place with the right networks established. And so this whole process of figure out your base case, pressure test your base case, make sure that you're aligned internally on that base case, identifying the disruptive drivers, and then preparing in advance for those disruptive drivers. I mean, that's the whole chain that we do when we forecast. And it's the exact same chain that we think clients are doing. The top clients that we've interviewed in our different sort of case study work when they approach their own business planning.
Yeah, and in a way, it's kind of the old line, if I thought there was a 25% chance my house would burn down, I'd make sure I had insurance. And to some extent, when we're looking at these potential disruptors, we want our clients to at least have them in mind and have some preparedness for them.
Precisely. And to that as well, if it's a 25% chance your house is going to burn down, you might want to look at the house too, right?
Right.
And so it sort of goes both ways, both in reiterating and changing your base case as well as preparing for the downside cases.
Yeah, and I'm sensitive also that all of our clients and all of us, quite frankly, are fatigued by disruption right now. So, the whole topic of potential other disruptions, we're super sensitive and empathetic to that, but nevertheless, they're out there and we should talk about them. So the process for creating this report usually begins in the July timeframe. So could you start by just showing the methodology for the report and essentially, where we whittle down hundreds of potential events and scenarios and we narrow it down, and this year it's down to a list of 6.
Yeah, so this is the global events to watch. And so we're talking about the true global events that we think that multinationals, sort of regardless of their portfolio responsibilities, are going to matter, right? A US-China event clearly has spillover effects to the rest of the world. There's also lots of events that are regional disruptors that we think are very important. We identify them in this report, but we don't think elevate to the need to plan at the global level for 2021 disruptions. And there's a lot of cases of that we can discuss as we go along. But the way that we start this process is we have a alignment process within our internal team. And so every month we have global meetings with every single research analyst. Our regional teams have their own internal research meetings, and that's to discuss forecast alignment, major events and trends, whether or not actions in Brazil or changes in Brazil might impact Argentina, things like that. We have country level analysts who have to meet with regional managers in order to discuss their own changes to domestic markets. So in this process of constant forecast alignment, what we do is we identify upside, downside, and base case scenarios. And around those scenarios, often the key drivers are going to be different views on these very potentially disruptive events. Sometimes those are domestic in nature, consumer confidence, housing prices, exchange rate shocks. In a lot of cases, those sort of bottom-up events, when we see a sort of panoply of those events where a lot of the world is worried about rapid exchange rate depreciations being possible, rapid turns in consumer confidence, those bottoms-up events sort of can get bucketed into large global events because of the risk that isolated trends can become sort of global trends via contagion. So one of our events this year is that sort of event, where you have sort of emerging market currency depreciations that occur in single markets that weakens investor confidence, it weakens domestic confidence in the faith of the currency, and that leads to a contagion effect into a global crisis. Other events are top-down, right, where we have alignment with basically the regional research managers along with myself and our head of research, sometimes generating ideas from other sources, and we think about what are these big political top-level events that we think could then spread down to impact other markets. And so a lot of events that have to do with the transition from the Biden administration, from the Trump administration to the Biden administration, possible changes in the foreign policy landscape. Those would be the sort of top-down events that we're identifying and then soliciting from our research team about what effect will that have on your country, and then pressure testing that view through the same process.
Okay, and I should point out that this discussion today is really only on the 6 global events, but in the research, you go region by region and highlight all of the various events that could impact regions. So I encourage our listeners to make sure they go through that, and we can always do follow-up briefings individually on some of those. Now, Events to Watch is our most downloaded and read piece of research every year. Historically, we've had a pretty good scorecard and hit rate on the events, and last year we identified 9 disruptive events. I will point out, I don't think anybody identified COVID-19, but I'm not sure anybody in the world did, certainly in kind of July, August timeframe. But we did identify 9 events, and maybe just before we jump into the 2021, how did we do in terms of hit rate and accuracy?
Yeah, we did so surprisingly well in 2020, and I think that the reason for that is, well, number one, let me say that the goal is not to get these right. So these are supposed to be low likelihood events under our base case designed for corporate planning. The goal is that we get the base case right, but we know that the world is uncertain and you have to prepare for that uncertainty when it is possible, when you can identify the source of uncertainty, and where it makes economic or business sense to take proactive preparation for those events. The goal of the report is to identify events we think that you can proactively prepare for to a degree. So 2020, we actually were very worried about the potential for a global recession in 2020. And this was because of 2019. The data incoming was very weak, especially for the Eurozone. We continue to see policy tightening in China. The US data was mixed, but seemed to recover late in 2019. But basically, we had 3 different macro events that were basically looking at a US recession, a Eurozone recession, as well as a sort of China slowdown. And we hit all those events, right? And that's because of COVID-19 to a large degree. We don't know if this would have happened absent COVID-19, but we were very aware that the long business cycle that we had coming into 2020 meant that there was limited room for policymakers to, basically the growth momentum was slowing to the point that any sort of a slowdown was going to tip those economies into a recession. And so COVID is the most extreme example of the kind of event that tips those economies into a recession. We thought that Elizabeth Warren initially was the main concern for winning the US election. So our base case was Trump last year. Our upside case was Biden, and our downside case was Elizabeth Warren. And so Elizabeth Warren did not win the US election. Eventually it pivoted to Bernie Sanders on the left being more favored. Both of those would have been problematic for the business environment. Instead, what we got was Joe Biden as our presidential candidate and then eventually president. Though worth noting that we switched to a Biden base case back in April of last year after COVID began. And beyond that, I mean, US-Iran conflict and sort of China abandons its reform drive, both of those events we had partial hits on in our estimation. US-Iran definitely had a pickup in concerns early in January with the killing of the Iranian general Soleimani, increase in tensions, increased troop deployment. That did create some issues in regional supply chains. And then China sort of widespread abandoning some of its debt targeting in ways that I think does concern. There are issues in the domestic credit sector that are not fully appreciated that we think will not result in a blow up of the financial system, but they're worrying signposts that we've observed in the last year. So that's kind of our hit rate for last year in our estimates.
Okay, thanks. All right, why don't we shift now to 2021, and we're going to shift, into the kind of the foundational baseline expectations, which then the 6 events are built on. And I think just to clarify for our listeners, as part of this events to watch approach, we establish certain baseline conditions. For example, COVID-19 is not a discrete 2021 event to watch, as it's essentially, part of the backdrop for 2021. It's become the base case. However, you do have certain baseline expectations in terms of the next evolution of COVID-19 and its implications in 2021 in the base case. So why don't we start there and talk about the baseline assumptions, first of all, with regards to COVID.
Yeah. So look, the good news here is that vaccines are on track for broad distribution across most developed markets, leading to herd immunity by mid-2021. That's been our base case since May. And the good thing is the timing is on track for that. That's also what's been signaled by US health professionals. And so that's the most rapid development of a vaccine ever, but it's on track to hit those targets. Both the Pfizer and the Moderna vaccines look very, very promising. We expect they'll clear phase 3 trials soon. They'll be distributed probably to primary care workers by December, if not January. And then we'll see the widespread distribution of those vaccines, basically generating a herd immunity. You only have to hit about 60% of the population for herd immunity with those effectiveness rates. And we think the dosage that's being produced and has already been purchased by developed markets is going to be enough to hit herd immunity by the end of 2021 via a few rounds. So I think by mid-late 2021, it'll feel pretty normal in developed markets. So you'll get that rebound in sort of domestic services, largely domestic tourism. But that's a long way away for developed markets still, right? In the middle of a second wave, which led to large national lockdowns in the Eurozone, what we expect is waves to recur. And so our basic modeling here is that, every 3 or 4 months, you're going to have policy tightening, followed by policy loosening, followed by some uptick in new cases, followed by some restriction in local activity. Being said, we did not expect second widespread national lockdowns, and that's reflected by falls in our forecasts for 2020 for a lot of those key Eurozone markets. But that's kind of the basic methodology here, is that COVID waves will continue to disrupt up until we get that herd immunity point. And then for emerging markets, for most of them, we expect that to take longer, about a full year longer. They'll have later access to vaccination. There's some distribution issues. Some key emerging markets expect early access, like in China. But you have to sort of we have a map that carves that out in the events to watch, and that's in our analyst base cases.
Okay, and speaking of timelines, in your report, you have a fascinating chart that shows a timeline of when you expect countries will return to pre-COVID levels of demand. And you have the majority of the countries, including some real big ones like Brazil and Germany, Japan, UK, France, South Africa, really not returning to normal until 2023 and 2024. That feels like deep scar tissue.
Yeah, it is. I think that optimism around the recovery path for these countries is not exactly earned. So we have been probably the biggest voice out there saying that, to go back to a discussion that was happening 3 months ago, this was not a V-shaped recovery for most of the world. And a V-shaped recovery is a very sharp recession driven by lockdowns in the second quarter of this year, followed by basically a rebound back above pre-COVID levels of activity, so back to the overall aggregate GDP and consumer spend levels of pre-COVID by the third or fourth quarter of this year. That's not what we saw for most of the world. China really here is the exception, and Vietnam, for large markets that have a lot of client interest. For most economies, like most of Western Europe, most developed world outside of the US, which is also a little bit slow, the problem with COVID is that you have a massive collapse in domestic spending on locally produced and consumed services, on travel. And the European governments have kept growth relatively, was it not for a massive social support by these governments, it would be a truly catastrophe situation in Western Europe due to the scale of the lockdowns and the slowdown. What's happening on the back end of COVID, even after vaccination in mid-2021, is that you're going to see it takes several years for all those small domestic services firms to rebound, and just for natural growth, which is so slow to come back. So what you have now is overcapacity. They basically built too much in terms of export manufacturing. They have too much in terms of local services provision, given the level of wage growth and employment growth in these countries. And we think in a lot of these countries, employment growth after the COVID-19 crisis will probably have to adjust somewhat lower, simply in order to cope for the fact that demand is weaker. And so you're basically hitting slow growth markets and forcing growth to go even slower. And that really explains that long tail. I think there's a further concern here, which is that there's a very important election in Germany next year in terms of who will take over for Angela Merkel's party. You have a conservative running against a more liberal politician in the CDU. And I think that the potential for Europe to spend additional fiscal money next year is certainly high, but also to start tightening fiscal policy much faster than we expect in 2022 or beyond. And so getting back to that kind of 60% debt to GDP targeting, which has led to such slow growth Europe over the past decade. And so I think there's real risks there to the long-term growth potential for a Europe portfolio.
Okay, I want to come back in a second to fiscal spending and deficits, but before that, just sticking with the baseline expectations. What are the baseline expectations that you have in your backdrop here for a Biden administration, and specifically around foreign policy, trade, and tariffs?
Yeah. So Rich and I actually did a call last week on sort of our U.S. election report. It's on the system for those who want to access it. Basically, we expect a Biden administration, and this is the problem here, is in our base case, we expect the Biden administration to largely normalize relations with Western Europe and with Latin America. And what we mean by that is this constant threat of tariffs that the Trump administration kept over Europe. Tariffs are in place, right? Number one, they're both steel and aluminum tariffs still somewhat in place. There's also tariffs on imports of EU consumer goods. We expect Biden is going to recommit to Europe and drop those tariffs, which never really made a lot of strategic sense, and to go back to focusing on a more process-based approach to dealing with European domestic subsidization that goes to the WTO. And the US is one case in the WTO against Airbus, amongst others. And so we think they go back to that process, which is less conflictual. We think that with China and with the rest of APAC, you're going to have certainly a change in tone from the Trump administration to the Biden administration, certainly more proactive and productive. We think that the Biden administration will try to engage with countries outside of China, maybe not going back to TPP, but trying to get back into having a leading voice and influence in setting regulatory standards in the region and trying to draw closer bilateral ties with these countries like India, Indonesia, Japan, that are so essential for maintaining regional stability against a rising China. And then vis-a-vis China, we'd expect certainly in a base case a change in tone, probably more positive engagement, some work together on multilateral issues of mutual concern, but that a lot of these tensions, especially on the national security side of the tariffs, high-tech imports, things like that, will probably remain in place. And we have an event that will focus a little bit more on the evolution of that US-China trade. The only one real loser in the portfolio is going to be Russia, where we expect the Biden administration to implement tariffs and sanctions, sanctions mostly, which will probably send the ruble a little bit lower. A lot of it's priced in. So that's really the one real clear loser in a sort of global portfolio from a Biden victory here.
Okay. Let's go back now to fiscal spending and deficits, and just so that we have a good baseline assumption, what is your kind of baseline assumptions around fiscal spending deficits across global markets, and why is this important for our clients to kind of monitor closely in the coming year?
Yeah. So again, this is a base case. So COVID-19 resulted in a massive increase in domestic spend, specifically on two main priority groups, right? So on emergency spending for healthcare sector in order to gain access to vaccines, to distribute the vaccines coming forward, as well as for a shift in priorities for local hospitals, right? Away from purchases of, ontological equipment and that sort of like standard package in order to save money to spend on COVID-related treatments. The second thing you have is a massive collapse in revenue, especially for emerging market commodity exporters, because commodity prices were so low and volume demand was so low, especially for a lot of the supply chains for those producers. So even if you're not a commodity exporter, if your largest regional market relies on commodity exports and the absence of commodity exports leads to weaker government procurement spend, weaker consumer spend, then that's going to have spillover effects on the rest of the world. What that's meant is that fiscal deficits have been rising. And so with the rise in fiscal deficits, that means that sovereign debt to GDP has been rising exponentially in some ways, not exponentially, but because both sides of the equation, right? Your overall debt size is increasing and your GDP has been decreasing. And again, we think that this leaves some scars in the economy. And that means that long-term structural growth might even be lower as a result of COVID. It's a recipe for a lot of questions about whether or not debt from these countries is secure. And so what we think governments are going to do, and we've already seen this in some advanced budgets, is cut spending in order to bring the fiscal spending lower to reduce the deficit, and then also increase revenues due to the need to, again, reduce the fiscal deficit and get their debt levels under control, because they're terrified of a collapse of investor confidence, both international investors as well as domestic citizens who might be worried about the health of the local banking sector who would then convert their local currency into hard currencies like dollars, thereby putting downward pressure on their exchange rate and causing a currency collapse. So to forestall both of those scenarios, which have happened many times, governments are taking this seriously. So this map, I'm going to show you two right here. This map is countries where we expect you're going to see fiscal spending cuts in 2021. And again, this will affect not just special spend from COVID, but also social spend in some cases, and in some cases, budget for government procurement. And so all of Latin America, most of Central and Eastern Europe and CIS regions, a lot of South Asia, and large parts of Sub-Saharan Africa are going to be seeing fiscal cuts. For fiscal spend increases, we really only have the sort of core markets of the US and Canada. That's going to be mainly due to changes that we expect in their budgetary environment, with both governments being friendly towards more fiscal spend on social spend. Western Europe, again, a social spend as well as possible infrastructure spend. And then China and parts of Southeast Asia, which have had a very different experience in the COVID crisis. The related chart to this is going to be about raising taxes. And so we already told you most countries are cutting. Now what we're seeing is, where are you actually going to raise taxes as well? Again, it's kind of a similar picture. So lots of Latin America, we expect tax raises. Orange there is consumer taxes. Yellow there is going to be corporate taxes. And then red is both consumer and corporate taxes. The consumer taxes might be VATs or other forms of consumer tax. You see a lot, again, across Russia and parts of Sub-Saharan Africa. But here you also see consumer tax increases likely in Western Europe, based on the expectation that long-term debt still has to get under control. And so this sort of mixed combination is an impediment to growth prospects for a lot of these countries in 2021. And again, that's baked into our base case and partly explains why these countries are lagging in terms of the economic recovery, is this tightening up of fiscal spend as well as the increase in the tax environment.
All right, and one last question just on baseline assumptions, and then we'll dive into the events. But during shocks, we often see our clients struggling with FX volatility, and I guess we've seen some of that recently, or in this year. What does your baseline model assume in terms of FX conditions going forward in 2021? Is that do we expect more stability?
So let me say that. So base case, we expect relative stability. We expect some of the emerging market currencies, like the Brazilian real, that were hit very badly in 2020, to gradually recover as their current account improves. So that means commodity exports improve somewhat with the rising global growth cycle. That leads to more price stability. Consumers remain somewhat resilient. And so in our base case for most emerging markets, we do expect relative stability. Of course, every currency story is two sides, right? It's what's happening with the local currency you're worried about, what's happening with your reference currency, which in most cases is going to be the dollar. We expect the dollar to remain relatively stable in 2021. A little bit of depreciation from these very large overvalued levels, but we don't expect the kind of sort of widespread 20% depreciation of the US dollar against a sort of trade-weighted basket that some investment banks are starting to talk about. And the simple reason why we don't believe that is that a lot of people are basing their view on the US dollar, this sort of catastrophic depreciation scenario, based on their view that a lot of US fiscal spend sucks in imports from the rest of the world, and that due to basically supply-demand models from like a Macro 101 textbook should lead to US dollar depreciation. We're skeptical the movement will be that big, simply because current accounts have been a very poor predictor of US dollar movements in the last 15 years. And so the last time we heard about that super dollar weakness narrative was like, 2016, 2017, and it didn't play out the way that people expected there either. And so we expect relatively more dollar stability. So in some senses, the risks from our base case, like our forecast base case, is relative stability. There's definitely some room for more than expected appreciation of a broad basket of currencies against the dollar if the current account becomes the main driver in a robust global recovery scenario. But I think what a lot of our clients are more worried about is not a gradual appreciation of those currencies. Again, for their emerging markets portfolio, the appreciation is good, improves local purchasing power. but the catastrophic risk of a depreciation, like we've seen in Turkey or Argentina in the last 2 years. So this chart is actually just looking at the risk of that kind of a depreciation in isolation for each currency. So we see here with Brazil, although we think that the base case is a little bit of appreciation, there is a potential for even more appreciation, but there's also a huge risk of a depreciation due to concerns about the domestic environment and the role of international investors and domestic confidence. So it's a very difficult picture for currency, and I think that hedging strategies will continue to be a priority. Even if things start to improve, an improvement in those currencies until these fiscal issues are resolved is really just a low-cost opportunity to implement less expensive hedging strategies, is kind of our view here.
Okay, good. Well, why don't we turn to our events for this year and unveil, or next year, and unveil them. And this year we highlight 6 events, as I mentioned, and you've got them color-coded, I guess, good, bad, and sort of middle of the road. And so maybe we could hit on some all around. And given we have about half an hour, I'm not sure we're going to get into all 6, but why don't we try to dive deep into 3, and then maybe we do how much time is left. We can try to take a quick turn around the remaining one if that works for you.
Yep.
All right. So why don't we start? Since I have the microphone, I'll choose the first event. Why don't we, just building on kind of the prior conversation a couple of seconds ago, why don't we start with the one that's kind of widespread emerging markets debt and currency crashes. I think you have this one at about 25%. Maybe just talk about the event in brief.
Mm-hmm. Sure. So just so everyone's aware of how to read this, I should just note really quickly. So our horizontal axis here is our perceived likelihood. And this is going to be the sort of disruption of the event. And so we're going to show you on the next slide, our base case is going to be a higher than 25%, obviously, but this is the sort of downside risk. It's a downside risk for everybody. Basically, it would hurt the global economy, it hurts global business. So if this happens, it's a red-coded event.
The thing about 2021 we're talking about, Ryan, just for everything clear. Yeah.
2021, sorry about that. And so it's actually a timeline sort of delineated event, as Rich says, and that becomes important for some later events. This is how fast the event hits. And so if it's a slow rollout, like it's a trade negotiation, we can monitor signs as they go. But for something like a currency shock, if you're not prepared before the shock hits, you don't have the weekend to prepare, right? It happens very fast and unrolls across the world in a sort of contagion effect, a massive risk off hits. So just to show you how this looks, this is how our events to watch sort of typology works for defining the scenario narratives. Again, designed for having internal discussions around the scenarios, identifying the fundamental drivers, and then helping you identify signposts to watch for your market monitoring. We won't read every text here, but basically our base case is relative stability in exchange rates and sovereign debt. We just talked about that. There is an upside of emerging market asset rallies on recovery optimism, which we sort of talked about. Our downside here is widespread emerging market debt and currency crashes. So what we mean by that is not that there's isolated events. So Argentina has issues, Turkey has issues, maybe one emerging market has a depreciation event, but it's isolated to that market. What we're worried about here is a scenario more akin to what happens in the Eurozone and sort of during the Eurozone crisis, during the Asian sovereign debt, or Asian currency collapse of 1998 to 2000, where concerns about a collapse in one market leads to a rapid swing in the international investment environment to pull money out of unrelated currencies or loosely related currencies, and that leads to a widespread collapse in these currencies. We put that at a relatively high likelihood, 25%. And the reasons for that, as we just described, is that you have ongoing COVID spending needs. You have tightening fiscal spend, which is designed to forestall investor concerns. But there's 2 main issues there. One is investors might demand more. Well, 3 main issues. Investors might demand more. The second issue is even if they improve the short-term fiscal spend environment, the medium-term projections for debt to GDP sustainability might look worse if GDP is revised structurally lower. And then I think the third main concern is that you're trying to cut fiscal spend and social spend during an ongoing pandemic in which large populations are in lockdown. And for emerging markets, they're not getting widespread vaccination in 2021. And so the frustration we feel in developed markets, which have already erupted in widespread protests in a lot of developed and emerging markets, that can lead to widespread political manifestations like we've seen take over in Chile or Colombia last year. And that itself can lead to change in governments, shifts in policy priorities, a about face in terms of higher fiscal spend, which would again not inspire investor confidence, or even a change in government. And so for myriad reasons, we are still much more concerned about these downside risks and think that despite the steps that emerging markets that are taking that are constructive to try to retain investor confidence, it might be hard to do that in practice across 2021. And so we want to flag this as a large risk to emerging market businesses.
Let's bring it even a little bit more granular then. So what specifically is the impact to our clients that operate in these markets in terms of their business environment and their demand conditions, and what actions, if any, should they be taking now to be prepared?
So one of the main issues that we're going to see here is, and we've seen this issue again already this year, is your local suppliers, distributors, any of your local channels, they might suddenly be a inability to acquire hard currency to finance imports. So for any import-driven businesses that are dollar indexed, you're gonna, number one, maybe just have issues even accessing currency for trade finance. And so extending, for companies that you think are sustainable, even if they can deal with the exchange rate depreciation, they might not be able to get trade finance. So working constructively with your teams, attractive leasing terms for capital equipment, given this shock, would sometimes be necessary in order to get over the hump of any sudden exchange rate depreciations. Additionally, you want to look at the margin impact. And so obviously there's going to be a big margin impact on moderate to severe currency depreciations, which will possibly make it unattractive or impossible in the short term to operate without generating a loss. And so those are the kinds of things we're broadly used to when dealing with big depreciations. And there's plenty of internal knowledge for how to deal with that from teams that currently have been covering Turkey or Argentina. The more widespread risk is a sudden flight to quality out of the local banking sector into either fixed sort of hard currencies or out of that country into the US and European banks, could lead to a collapse of confidence in the local banking sector. And so those are very difficult to plan for, but you want to be pretty careful about making sure that your cash flow cycles are short. So don't relax that back to a 3 or 4 month cash flow cycle. Really maintain discipline on making sure that your cash flow is on a 1 month cycle, probably 2 months at the longest. The sort of discipline measures that we've sort of learned and sometimes relax with some of our key vendors need to be prioritized.
Okay, great. Let's move to the next event, which is the U.S.-China partial reset. Now this one, at the headline level, seems kind of obvious with a change in the administration, given, I think the stance that President Obama and Biden had taken with China versus the harder line stance that the Trump administration has taken. You put this one only at 20% probability. So can you maybe explain the event a bit and then tell us kind of why this is an event we should be watching, and what about it that we don't already know?
Definitely. So this is our upside event in this case. We put it at a 20% likelihood. It's a yellow coded event and not a green coded event, because if US and China get to some sort of trade normalization, it's going to hurt some countries like the US. It's going to hurt global growth, but it might have a negative somewhat impact on large emerging markets that have stepped into the US's role to provide things like agriculture. So countries like Brazil or Argentina would see a little backstep from this. But let me step back and address the question. As Rich pointed out earlier, these are 2021 events. And so we're really looking at what happens next year, a year which is complicated by many things. One is that Trump is likely, before he leaves office, to implement even more stringent policies on China that will be difficult for Biden to unwind. And that's been flagged by a few different policymakers recently. The second is it's very hard to have face-to-face meetings amid COVID. And this is going to require talks between Xi and Biden probably over multiple days, including whoever Biden installs as U.S. trade rep, and it's going to involve whoever Biden installs as Treasury Secretary and as Commerce Department Secretary. We don't know who those will be, probably until January or February, and then they await Senate confirmation, which could be conflictual, depending how the Republican Senate chooses to take a stance, which means that we're not really starting talks for a couple months into 2021. The other problem is that the Obama administration initially did its pivot to Asia and tried to approach China as what we'd call a strategic partner. And the Obama administration hit many issues with that approach when trying to engage with China. And it hit a lot of the same issues that the Trump administration eventually starts to complain about. Unfair domestic subsidization, IP theft issues, other competitive and structural forces that make it difficult for US companies to have access to the Chinese market. They make it difficult for US firms to compete both in China, but also how Chinese firms then are leaving their footprint on global markets via some various things like acquiring international companies at what Western companies would think were below fair value multiples, because Chinese companies are financed cheaply, they're subsidized, and they have strategic concerns over acquisition that are not driven by market fundamentals. So even in later years, the Obama administration started to tighten the noose a bit on China and some of these practices. The Trump administration kicks that into overdrive on two different ways. And this is the bifurcation that's critical here. The Obama administration identified specifically concerns about Chinese as a strategic sort of competitor. And so what the Trump administration said is we have to protect the ability for US firms to maintain their primacy in innovation. And that will involve a lot of steps like restricting exports of high-tech goods to China, restricting IP flow to China, as well as taking actions against Chinese firms that have been known to steal US technology, either through reverse engineering or stealing IP, as well as to punish Chinese actors that we think are bad faith, like Huawei, which was seen, or ZTE. ZTE had undercut US sanctions in North Korea. We think those largely strategic imperatives are going to remain. And so we don't think a Biden administration comes in and reverses steps implemented by the Trump administration to restrict high-tech technology exports to China. We think that some of the domestic espionage allegations against China will continue to drive US policy towards China, restricting flow of research, university professionals. But the upside here is some of the later tariffs imposed by the Trump administration were targeting low-wage, low-cost consumer goods that Biden has seen as a tax on US consumers in spaces where the US is really not trying to compete. Think textiles, think low-cost consumer electronics, some supply chain components that are sort of low value add. And so the space here is in the upside event that the Biden administration is able to engage with the Xi administration and work to drop some of these later stage consumer tariffs that are not strategic in nature in exchange for either Chinese promises on dealing with IP theft, domestic structural issues, as well as engage on multilateral efforts by the US to re-engage with Iran, as well as to re-engage with North Korea and climate change as well. And so that's where we see the potential for an upside event. It's still a different US-China than before Trump, but it will feel much better, especially for some of those consumer goods companies.
Any specific actions our clients should take now to be prepared for this?
This one is a little bit more wait and see, but I would say this. Optimism about a rapid unwind of US-China tariffs on tech goods, we do not expect is likely. And so in a lot of ways, what we reiterate here in this event is our long-standing view that US-China decoupling for both fundamental as well as for political factors is ongoing. And so we think really carefully assessing any US-China direct or indirect supply chain links will continue to remain something that should be a focus of strategic planning conversations. In terms of contracting, a lot of companies are looking to diversify their import of consumer good textile goods already just due to these tariffs, which are unsustainable from a margin perspective. They've been looking at places like Vietnam, which is getting kind of full, They've been looking at Mexico with the new USMCA deal signed. But a lot have said that we're going to stick in China and see how this works. And so I would say that if you've got a really historically strong business in China from a consumer goods production and export footprint to the US, it's not a time to panic sell, even if you're continuing to think about localizing to Mexico, which might have attractive economic benefits, even if tariffs are dropped. And so it's kind of a more mixed one, I would say, on that sense.
Okay. I want to move to our next event, which is related to oil prices. In this event, you believe that oil prices will move out of the current range, and which direction will they go? Trick question. And what's the probability of that?
Yeah. So in our base case for oil market averages in 2021, we expect around $50 for Brent and a little bit back for WTI, so about 47 to 48. We have been, so during the upward swing in 2020, we kept a below market consensus view on oil because we expected secondary waves to break out, as we described in our base case. That would lead to a pullback in mobility. And we didn't expect a rapid recovery in airline transport. And both of those have come to be at relatively good forecasts. And that really informs our view for the base case for next year. And so we do expect a gradual recovery to start taking place in the back half of 2021. That will lead to inventory depletion, as long as OPEC maintains some semblance of quota control over production, and as long as US oil production falls off a bit due to lack of reinvestment into shale due to relatively low prices. So that explains kind of our 50 average, which means that you have some of the year sub 50 and the back half of the year over 50. What we're really talking about here not is oil going to 62 or 63 at the end of the year. What we're talking about is, what if there's a sustainable movement higher or lower in oil? That means that your annual averages really break out of this range. And you can see in the past, there's very few periods, really only 2011 through 2014, and then for a little bit right before the 2008 crisis, where oil was really sustainably on average outside of that range. There are some potential drivers for it, and that's what we're talking about here. And so this event is a bit different because oil is inherently uncertain. Attempts to model oil price forecasts have been the worst performing forecast of basically anything. Averages are a bit easier, and so we have a little bit more confidence, but we basically say it's equally likely that oil falls below 40 or rises above 40. And this is a large part because of uncertainty around the demand recovery, but also uncertainty around OPEC and US shale production. The markets are definitely biased towards an upside scenario. And so that upside scenario where oil prices sustainably rise is going to be driven by OPEC maintaining quotas, strong fiscal policy and a global recovery taking place that really drives up demand, and then mobility picking up. And so that mobility pickup will be due to herd immunity in Western markets and developed markets, and also a bit of a pickup in emerging markets just on confidence of basically improving local conditions. We're already seeing a pickup in Chinese demand, and that's going to be a big driver. We haven't really seen the pickup in India demand yet. And so while we expect a pretty good recovery in India next year, we have a bit more bearish forecasts for India recovery without not happening until 2022. And that means that oil demand growth for India will be relatively weak, despite being one of the fastest growth markets pre-COVID. So I'd say that's most people's focus. The downside scenario is basically driven by weaker demand growth, fiscal tightening, widespread currency crashes, a lot of those other events we've talked about, which intersect to basically pull down growth and reduce mobility as OPEC countries get frustrated and start to release more oil onto the market in order to hit their own domestic revenue shortfalls. And so I think both are very possible. And obviously the preparation here is, it's almost asymmetrical, right? Which is you need to prepare for both an upside and a downside, but for most businesses outside of the oil sector and related sectors, the upside risk is the one you're more worried about because it will impact consumer budgets. And so preparing for that upside scenario is actually more important in a lot of cases for our companies who rely on sales to emerging market consumers that will have to pay more for oil, and that will lead to a tightening of their spend elsewhere.
Yeah, it's a tricky one because it affects, there's some winners and losers in either scenario, both from a country portfolio management of where to invest resources, but also from a end user demand perspective. So this one is one where I think regardless, contingency planning is a must because it could go either way. And as you point out, you want to be prepared. All right, so we've got about 8 minutes left, and I want to now do a bit of a speed round for the other 3 events if we can. So we're gonna go fast, and here's what I mean by fast. For each event, let's have a brief explanation, and then 2 to 3 key impacts for multinationals and/or actions they should be taking to think about this event. Okay.
Got it. Yep.
So let's start with the U.S. and Iran. And the potential for a new nuclear deal, which you put at 25%. And given, again, Obama-Biden administration being instrumental in creating the first nuclear deal, give us the quick elevator pitch on this one and what it means for our clients.
Yeah. So Biden has said repeatedly he wants to return to the nuclear deal. It's called the JCPOA. Some of the Biden administration, we don't know the administration yet, but some voices near him have indicated that they want to expand the deal to include some other elements like conventional missiles before signing on to a new deal. Iran has said that they are willing to suspend uranium enrichment if the Biden administration agrees to drop sanctions, which were put on by the Trump administration after they left the JCPOA. But timing here is difficult. So you have to get in, do a round of serious negotiations. We don't know who Biden has yet, and Iran has an election in June or July for the presidency. And so we think that they will constructively probably get to the negotiating table. The question is just how quick that happens. And that's why it might not be a 2021 event, but it might be a 2022 event. We definitely think this is the approach that happens, barring some sort of sea change in the region. So implications for multinationals. Not many US firms were doing business in Iran, but quite a few European and Asian firms were. And what the US did under Trump was restrict their ability to continue those trade flows by restricting access to the SWIFT network for international banking. So as soon as the Biden administration agrees to drop those blocks on the SWIFT network, that will allow European banks to transact with Iran again, and you can get your contracting back to normal. That will also give Iran revenue inflow from better oil export footprints, and they'll have cash to spend. And so that's really the outlook. It's going to affect a couple B2B companies that mostly do procurement stuff with the government, and B2G that does procurement with the government, as well as for some consumer brands. So if you're interested in Iran business, you probably already are watching this. If you aren't in that business, but you think that it might fit your portfolio, getting in early is going to be the way to get those initial contracts because they're hungry for deals.
Okay. Next up, you have an event around anti-vaccine backlash that slows the adoption rate of the vaccine, and you put it at a low probability, 10%. And it's multifaceted in this case. Can you describe that quickly, given the good news we've gotten in the last week from Moderna and from Pfizer? Is this a real?
So it's real, but we put this as low likelihood. But here's the problem: we're trying to vaccinate the entire world with a vaccine developed in less than a year. We're trying to vaccinate the entire world in 2 years, and so there's just a lot of issues that can pop up, right? Number one, we know there's strong anti-vaccine movements in some of these countries like the US already. Number two, social media has become very good at spreading disinformation. And we think that can lead to concerns by consumers who hear of isolated reports, real or fake, of issues experienced with vaccination that will lead them to wait on further vaccinations to take place before they line up to take their own dose. So what that does is it slows the recovery of consumers in the marketplace over fear. That can happen for a lot of ways. Pfizer requires cold storage at -70°C. It requires 2 shots administered over 28 days. It's very plausible in my mind that you could see someone not cool the vaccine quite properly and have some isolated side effect incidents that happened with a flu vaccine in South Korea earlier this year. And so it's a concern to note is that there's a path to optimism, but there's definitely potential for fallbacks. And so don't relax your discipline on local monitoring and on some of your cash flow management until we're really in the clear here.
Okay. And finally, the last event is the U.S. takes a leadership role on climate change, about a 180-degree move from the current administration. You put this one at 15%. Let's talk about, in brief, what it is and why our clients need to be focused on it and implications for them.
So our base case is that the Biden administration will face a hostile Senate, will face a Republican Senate. That's yet to be fully determined, but we don't think the Democrats win both seats in the Georgia runoff. Even if they do, there are Democrat senators from coal states that will be reticent to approve widespread climate legislation. So our base case is Biden basically uses administrative authority to implement rapid increased regulation, undoing the Trump deregulation of the energy space, as well as implementing new energy efficiency standards through the EPA, through the Commerce Department. The upside here is that Biden decides to go really bold, and instead of doing 2035 targets for efficiency required by U.S. firms, what he does is he says, well, if I put in 2035 targets, the next administration, which might be a Republican, will just reverse those. Is he really forces firms to upfront a ton of investment, which will be costly in the short term, to hit compliance standards and face exorbitant penalties if they don't hit those, as well as basically making climate change a foreign policy priority and approaching countries like Brazil, which are known to be relatively high polluters given their level of sort of GDP and per capita spend, and to say, look, you guys have to take this seriously, or we're going to take a variety of steps to make it more difficult for Brazil to function in the global economy. So we think that this is a high likelihood to be disruptive in either case. But the question is just how far does Biden go? Does Biden sort of take some of the approach that Trump has tailored about being really big with executive authority and really challenging what U.S. legislators have previously thought executive authority entailed in order to really get climate change done, to implement climate change policies much more actively than we would otherwise expect?
Okay, good. Well, Ryan, we're up against time, and I just want to thank you. I mean, we could go on, and we've barely scratched the surface, but thank you so much for this excellent, insightful discussion. And thanks also to our listeners. We've barely scratched the surface of these topics on the global level, but also, as we said earlier, the research dives into regional specific events as well, which I encourage all of our listeners to read the analysis and also schedule individual briefings with you or other members of our regional teams on these events as part of their upcoming leadership meetings. One of the things we advocate out of all of this is just doing some contingency planning now, so that if any of this comes to pass, you're not reacting, you already have some plans in place. And we didn't get to talk through this methodology, but we're happy to do that at a future time. The report itself is extensive. It provides detailed scenarios, signposts, and suggested contingency planning frameworks around these events. So please take a look at those. And as a reminder, any FrontierView client can speak to Ryan or any member of our global research team at any time by scheduling time through your client relationship director. And all of FrontierView's research and award-winning data, analyst insights are available and always updated on the FrontierView desktop and mobile application. This concludes today's webcast. Thanks again for joining us, and we look forward to speaking with you again soon. Be safe, everybody.